So one of the most popular ways to build tax-free wealth is through a Roth IRA. But a lot of high income earning individuals can't participate because of the phase out limits. So there is a hack out there that allows you to convert your traditional account to a Roth account, even if your income is above the threshold. So in this video, I'm gonna be talking about what a backdoor Roth IRA conversion is and how you can execute it on your own. Let's get it. Hey, what up guys? Brian Rivera here, CPA, and I wanted to welcome you to my channel. So on this channel, I typically talk about topics such as this, along with personal finance, entrepreneurship, and day trading / investing. So if this is your first time around here, consider subscribing. So you probably heard many great things about the Roth IRA, maybe at the coffee shop, maybe a coworker, maybe a friend, they told you about it. And I remember the first time I heard about it, and it was really in one ear, out the other. Simply because I was too young, and at that point in my life, I was really much focused on life of the party and having a good time. And so as my family was growing and I started thinking about, the next generation, our income started getting too high to contribute. So if you are single and you make over $139,000, or if you're married filing joint and you make over $206,000, your income level is actually too high to be able to contribute to a Roth IRA. And if you're below that income level, both you and your spouse can contribute up to $6,000 per year into a Roth IRA. So now on to the $1 million question is, how do you build that tax-free nest egg when you can only contribute $12,000 a year if you're married filing joint to a Roth IRA plan? So there's two ways that you can actually do it. The first way is, if you are self-employed, you're an entrepreneur, you got a business, you can do it in that way. You can have a plan inside of your business. Now for everyone else who doesn't have a business, the second way to do that is through a Roth backdoor conversion, and we're actually gonna get into that right now. All right, so let's get two basics out of the way. So a traditional IRA is typically funded with pre-tax dollars, and your money grows tax deferred. So you actually don't pay any income tax on it right now, and you will pay income tax on it at retirement age. So when you start to pull that money out, you will pay ordinary income tax on your distributions. And now a Roth IRA is an account where you contribute post-tax dollars, so you don't actually get an immediate tax benefit when you're contributing now. However, that money grows tax-free, and when you hit retirement age, you can actually pull that money without paying any income tax on it, because you're funding it with post-tax dollars. Your income is now growing tax-free, and when you want to pull that out, there's no income tax on it. I mean, that's, in my opinion, that is the best way to build tax-free wealth. So as I mentioned earlier, there are some phase-out limitations. Again, so if you're over 139,000 single and over 206,000 married filing joint, you can't participate in this. However, you can get inside that through doing what's called a Roth IRA conversion. So now the process to do this is actually pretty simple. So the first step is you actually have to have money available. So maybe you have an employer-sponsored plan, or maybe you had a traditional IRA where you were putting money in. So the next step is you're actually gonna contact your retirement plan administrator. So if you use Fidelity or E-Trade or whoever you have, you'll reach out to them and you'll say, hey man, I'm trying to do a Roth IRA conversion, and they'll give you the required paperwork to fill out. In addition, if you don't have a Roth account open, they will also give you the paperwork to actually open the Roth IRA account. Once the conversion, or once the paperwork is completed, now you gotta be prepared to pay the tax, right? So remember, only post-tax dollars go inside the Roth IRA. So when you do the conversion, you're gonna pay ordinary income tax on the money that you converted to a Roth. So make sure you have that money set aside. And typically, I recommend that you don't use the money that you're converting. Only do this if you already have the cash aside to pay the tax. Also keep in mind that if you have significant investment gains from that traditional IRA account, it might be a pretty big tax bill depending on how long that money has been sitting inside of that account. Now there's two things to keep in mind when you're about to do this conversion. Number one is the type of transfer needs to be a rollover, a trustee to trustee, or same trustee type transaction. With a rollover, basically what happens is your institution will give you the funds, and now you actually have 60 days to deposit that into your new account. In a trustee to trustee type transaction, that is actually where your institution will wire the money directly to your new institution. So for example, if you are wiring funds from Fidelity to E-Trade, they will do that on your behalf. And so a same trustee is basically where you have all your accounts, and let's just say you're going from the traditional to a Roth, all within inside the same exact broker. The other thing you need to think about is there is some IRS guidance out there called the pro rata rule. So basically what that means is when the IRS is going to be determining your tax bill, they're going to look at the value of all of your traditional IRA accounts. So let's just say all of your traditional IRA accounts include 70% pre-tax dollars and 30% post-tax dollars. The IRS is actually going to use that percentage applied to the value of your Roth conversion, and that's how they determine how much money you're going to pay income tax on. Some things that you can do to mitigate this is maybe try and convert a smaller IRA to a Roth IRA so that way the tax bill is not that big. You can also roll larger IRAs into your employer-sponsored 401k, or if you're self-employed, you could roll that into a solo 401k type plan. Now the IRS applies the pro rata rule to the balance of your IRA at year end, not at the time of conversion. So a lot of times people try to time a stock market correction when really this calculation comes into play at year end. So big picture, when is this a bad idea? So if the only way that you can pay the tax is from your existing IRA balance, you're gonna be sacrificing future gains on that money. So if you can't pay the tax out of pocket, it's typically not a good idea. So if you need the money in the next 5 years, money converted to a Roth falls under the 5-year window. And so if you know you're gonna need it in the next 5 years, it's probably not a good idea. And you also don't wanna get hit with that 10% early withdrawal penalty. Now, the other time it's a bad idea is if the conversion is gonna push you into a higher tax bracket. Now remember, you're paying ordinary income tax on this conversion. So if it's gonna change your tax bracket, it's typically not a good idea, and you wanna wait to a year where your income is a little bit lower. Now 2020 is great because there's a lot of things that have happened. People have been unemployed, people got laid off, income have shifted in their personal situation. So you wanna wait for a year where your income is a little bit lower. All right, so when is a Roth IRA a good idea? Number one, it's gonna be when the stock market is down and you are in a lower tax bracket, because when you pay tax on that conversion, you're not gonna pay as much tax because you're in a lower tax bracket. So if you have significant business losses, that is an opportune time to execute this strategy. 2020, it's been no secret that it has been a rough year on a lot of small businesses. So if you generated a net operating loss, this is the perfect time to execute this, because what happens is your net operating loss is gonna offset any of your backdoor Roth IRA conversion dollars. So if you lost 100,000, you converted 100,000, theoretically, you may not pay any income tax on that conversion. So if you have a significant business loss in 2020, now is the time for you to do it. Thank you for watching today's video, and I hope you learned a thing or two about how to execute the Roth IRA conversion. If you found value in today's video, don't forget to smash that like and smash that subscribe button, and have a good one.